Hi, Sarah. Thanks so much for your question. It's a really good one regarding investing your super passively as opposed to using active management. And then the second part of your question is really around how conservative or aggressive should you be with your super investments. And it's really good timing because I've just written a blog specifically about this topic. So let's talk about the first element first, which is passive versus active. So there's an overwhelming body of evidence that demonstrates that very few active managers can beat the index over a consistent and long period of time. So about 30 or 40% of active fund managers will beat the index over the next 12 months. But of those ones that beat the index over the next 12 months, very few of them will do that for the second year in a row, about 5%. And less than 1% will do it 3 years in a row, and virtually none will be able to do it 4 years in a row. So if you're going to use active management then when investing in the share market, you need to pick which active manager is going to be the best over the next 12 months. You probably need to sell at least half of those and reinvest to pick the next winners for the next 12 months. And you need to pick those winners consistently well in order to beat the index. That's based on the stats, about 30 years worth of data really that the Dow Jones S&P have been tracking this. So of course, most people would agree, well, that's just not going to happen. So let's just invest in the index. Now, when it comes to super, a lot of super funds have index options. And a lot of super funds over the last, say, 5 years have been insourcing investment management, which means that they're going to manage the investments. They're going to build an investment team and they're going to manage the investments as opposed to getting professional managers to do it, particularly for index portfolios, because you don't need really any skill. You're just buying the index or replicating the index. Now, whether they can do that perfectly well is another question, because there's a lot of intricacies that associated with trying to track an index really closely and reducing the trading costs and those sorts of things. But I'm a bit skeptical. So industry funds are obviously run by the unions. Now, they'll say they're not, but half of the board are union members, the other half of the board are union sympathisers, and very much there's very close links and ties to the union. It's been well documented that industry super funds pay sponsorship money to the unions, and it's a big pool of money for them, a pot of money for them. Unions, as we all know, are pro-employment. Their job is to represent the members and hopefully grow the workforce rather than reduce the workforce. Now, if the index options in super were to be successful, they will need fewer people, not more people, in their investment team. So the skeptic in me says that I don't think index will ever beat their normal actively managed option. So, if you wanted to invest, say, with Australian Super, you could have an option of investing in Australian shares, which is just their general option, or Australian shares indexed. I don't think Australian shares index will ever beat Australian shares, because I'm skeptical about how that's managed and the impact on industry super funds. So whilst I am pro indexing and all the evidence suggests, I think we've got to look in context of the super environment, particularly if you're in industry super. And for that reason, I would actually stick to their generic options that they manage, which will include some indexing probably, but also will still include some active management, because I think you've got to invest where the money is, and that's really where the money is for them, because they can continue to grow their workforce, which they have. And by the way, they haven't achieved any productivity or scale whatsoever, but that's for a different element. Sarah, you made a comment that potentially index is more volatile than active. It could be, but not necessarily. I mean, there's nothing to suggest that indexing should be more volatile. It's really going to depend on the active comparison that you utilize. So I don't think you shouldn't expect any major differential in volatility between active and passive. So I guess we can put that aside. The second element to your question is, how aggressively do you invest? And something that we've been talking about internally within our business for a little bit of time. On Wednesday, the 26th of June, 2024, so just I thought I'd mention the date in case, I don't know when you're watching this video. I will or have published a blog that talks about that, and we'll make sure that we'll put that in the comment section to this video that you can check out. And the blog discusses the thesis around, should you just invest 100% in shares? Now, you said you're in your early 40s, you're not going to access super for probably nearly 2 decades. We know that the share market over the next 2 decades is almost certain to provide the highest returns. So why wouldn't you put it 100% in shares? Anyway, have a read of the blog, because I've consolidated all my thoughts in that blog, and hopefully that helps you. But great questions, and thanks for sending them in, Sarah. Cheers.